Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
Financial Survival Network is presented to you by Regal Assets. Buy and sell physical gold and silver through your existing retirement plan, 100% tax-free with Regal Assets. If you want to include physical gold or silver in your existing IRA or old 401k, request your free investment kit, which was recently featured in the Forbes and Smart Money Wall Street Journal magazines. Call toll-free 855-678-6620, 855-678-6620, or visit regalassets.com. Today's sponsor is Audible.com. They're a leading provider of spoken audio information and entertainment. Listen to their audiobooks whenever and wherever you want. You know, I do a lot of driving. I'm always listening to an audiobook, and I love it. I couldn't live without Audible. If interested, go to audiblepodcast.com/Lutz. audiblepodcast.com/Lutz. You're listening to the FinancialSurvivalNetwork.com. I'm Kerry Lutz on 1590 WPSL. When we had Jason Hartman on last time, got a lot of feedback, and some of you questioned certain things, certain statements that he made, and I want to give Jason a chance to clear it up now. Jason, welcome back to the Financial Survival Network.
Hey, thanks, Kerry. It's great to be here, and I'm glad people are engaging and listening, even if they don't all like what I have to say.
Nobody's going to like everything of what anyone has to say. If they are, I don't really want you as a listener because you're not a thinking human being. But one thing people ask, Jason, is what about lousy tenants?
Yeah, right.
You get these people like the tenants from hell.
Yep.
that redecorate your place with a sledgehammer. And I guess you can insure against that to some extent, but in certain jurisdictions, it takes you months to dump these people, to get them out. Yeah. And they're worse than a loss.
Well, very good points, Kerry. So first of all, just to give a little context, in case someone didn't listen to the last interview, we discussed, Kerry, you and I, we talked about gold and silver and compared it to income property as an investment. And, I just want to clarify that I own some gold and silver, and I think it's okay. I'm not against it. I think it's far better than fiat currency, than paper and ink, because it does have intrinsic value. But again, I think it's a defensive strategy, and what I'm proposing with income property is an offensive strategy to actually make gains rather than keep pace and not have your wealth destroyed through inflation and government stupidity, as it were. But when you talk about income property, it is far from perfect, Kerry. And my first property that I purchased when I was at the ripe old age of 20 years old in Huntington Beach, California, was a problem initially. I had a bad tenant. The tenant wouldn't pay their rent. I was just a kid. I was in college, and I bought this little one-bedroom condo on Coventry Lane in Huntington Beach, California. And, I was in real estate. I bought the property back from a client. He didn't like the property, and he said, "Why don't you sell it for me?" I was a realtor part-time while going to college. And so I said, "Hey, rather than me selling it, I'll just buy it from you." And I was really excited. It was my first investment property. And initially, it was a very bad experience because, they paid rent for a few months and then they stopped paying. And, I was just a kid and I went to knock on the door and ask for the rent. And they just made excuse after excuse. It was a young couple there. And then I brought one of my buddies from my Century 21 office with me. And he went with me and kind of gave him a hard time and said, "Look, Jason has to pay the mortgage even if you don't pay his rent." Blah, blah, blah. And, that didn't work too well anyway. So I finally had to evict them. And, they left the place a total mess. It was in complete shambles. And, I had to fix it up. And then a local broker, I put it back up for lease, and a local broker approached me and said he wanted to buy it from me. And it turns out, on my first little property, I made $30,000 So even though I had the loss of, the bad tenant experience, which typically would have derailed most real estate investors and they would have given up on the whole idea of investing in real estate, it turned out to be pretty darn good. And with those gains, I bought my second property, and I made about $60,000 on my second one, and I just kept going from there. And overall, it took about 21 years to have my second eviction, my second bad tenant. My first tenant was terrible, had to evict them. They left the place a disaster, lost some money on fix-up costs and so forth. But it took 21 years before I got another lousy tenant. And, during that time, I had, I don't even know, but dozens and dozens, maybe over 100 tenants in and out of different properties I owned over the years. And, you hear these horror stories, and they do exist, but by and large, they're relatively rare. You don't usually hear the good stories. Nobody talks about, hey, I've got great tenants and no problems, and they pay the rent. Everybody talks about the negative things. That's just kind of human nature. But here's the thing about it. Number one, you mentioned, Kerry, rightfully, in some of these jurisdictions, it could take you months to get a tenant out of your property. And that's why we recommend investing in landlord-friendly markets. In places like Texas, Georgia, the Carolinas, generally the Southeast, Arizona also. These are markets that are landlord friendly. Markets like the Socialist Republic of California, those are tenant friendly markets.
And New York and New Jersey.
New York, and anything in the Northeast, generally speaking, anywhere where, they vote for Democrats. Anywhere where they believe in big government.
Hey, this is a family show, Jason. We don't talk about political affiliations here. This is obscenities here. We don't deal with that.
Well, look, I will just tell you that jurisdictions where people believe in big liberal government are landlord unfriendly. And those are places you want to avoid. So, we help people invest all over the nation. And our markets are landlord friendly. So if you have a problem, it's much easier to get rid of a problem. Okay. But the other thing I want to say, Kerry, is that income property, unlike gold and silver or many other investments, non-dividend paying stocks, etc., it's a multi-dimensional asset class. So you've got so many elements to the investment. So say you have a bad tenant experience. Well, that could ruin your cash flow for a time. But you have tax benefits. Remember, the government is participating with you in losses and actually, in a way, in gains. Because if you qualify for depreciation, making income property the most tax-favored investment in America, bar none, there is literally no competitor that even comes close to the tax benefits of income property if the investor qualifies for all of the benefits. And, on my show, I talk about ways people can do that and so forth. And, you have capital gains opportunities, tax benefit opportunities, cash flow opportunities. There are always ways to adjust. There are ways to add value and be creative. The imperfections in the marketplace, where no two apartment buildings are the same, no two homes are the same, that creates opportunity. I love those imperfections. And I love the fact that income property is largely an unsophisticated marketplace compared to Wall Street, compared to the metals markets. Those are very sophisticated marketplaces. They're very perfect. And what I mean by perfect is, the spot price of gold is the spot price of gold everywhere on the planet at that time. Real estate, it's a little iffy. There's you can add some value. You can be creative. You can, it's not so perfect. And it's not like a stock exchange where the prices are set in stone. And that's what's beautiful about it. Unsophisticated marketplace, largely, imperfect marketplace, that leads to opportunity. And, let's just look at an actual property that we have for sale right now on our website.
I just have one question for you, because I've been looking at income property for a while now. Haven't gotten involved in quite a while. But what is your feeling as far as single-family home versus a duplex, triplex, or four-family home.
Yeah.
Where's your preference there?
Well, that's a great question. Historically, you can make the most appreciation potential on a single family home. Okay. But when you go above 4 units, when you go above the fourplex concept and you get into 5+ units where it's classified as an apartment building, okay, and the lending standards are different and so forth, there you can do some creative things in terms of adding value by increasing the revenue the property creates, and there can be some big gains there. But just simplicity speaking, anything 1 to 4 units, the price or the value of that property is not based on the income it creates, it's based on the comparison. And that can be very, very good because it's sort of illogical. It's sort of back to my statement about it being somewhat imperfect. A single family home will typically give you the opportunity to get the best quality of a tenant. Okay. A
Right.
duplex or a triplex or a fourplex or a large 125 unit apartment complex like the one I have here in Scottsdale, Arizona, generally your tenant quality is lower. You'll get a nicer quality tenant usually in a single family home. But again, your income to value ratio is not usually as good in a single family home as it is in a multi-unit property. Because you have a little more economy of scale in construction and so forth in a multi-unit property. So, it depends. And we say you should diversify your portfolio. I own single-family homes. I own large apartment complexes. I own, small apartment buildings. I'm diversified, and I'm diversified geographically as well, because all real estate is local. And so you want to diversify geographically into landlord-friendly jurisdictions.
Right.
Like we mentioned.
Like Atlanta. And I'm looking at your site, jasonhartman.com. I clicked on properties available in Atlanta, and there's one here that has a 47% ROI, which looks almost too good to be true.
Yeah. Well, it's pretty amazing. I mean, we put in some very conservative assumptions. One of the things I remember, one of my original real estate teachers back when I was just 20 years old, I was in college taking all these real estate classes, and one of the instructors was so good. He had this saying. He said when you puff up these projections, this is what we call the hokey broker goes to jail projection. Okay. and people can put anything on a pro forma, Kerry, and it's really important that in the pro forma that you include a vacancy rate, that you include rental losses. You might get a bad tenant, that you include reasonable management fees, because we recommend that our clients have managers, so we don't manage our own properties. So that story I told you about, my first property that I self-managed, where I was knocking on the door to collect the rent, none of our clients do that. Okay, they all have professional management, and there are good and bad managers. You can have managers that rip you off. This is far from perfect. Okay, but when you look at something with a projected 47% annual return on investment, and you can see at jasonhartman.com in the property section that all the numbers are there. The vacancy losses are there. The management fees are there. The appreciation projection is very reasonable historically. The maintenance costs are in there. This is not pie in the sky by any means. It's just that because income property is a multidimensional asset class, and it's the most tax-favored asset, and it's the most lending or debt-favored asset, and leverage-favored asset, that you can get these kind of returns. And it's hard to go over numbers in an audio format.
Oh, no.
It's not visual, so we can't really do that too well. But here's what I will say, Kerry. Look, Bernie Madoff, who made off with, $60 billion, okay, one of the biggest Ponzi scheme crooks of all time, his promise to investors was that they could consistently get between 8 and 12% annually. That was his big promise, and that's how he attracted so much money to his Ponzi scheme, okay? Now look, even if this property goes only half as well as we project that it will, and we have a very long track record of doing this, okay? And I have a very long track record of investing personally and doing as my clients do, investing in the same markets, the same property types. So in some cases, I own properties, on the same street as my own clients do, okay? But even if it only goes half as well, what is half of 47%? Well, that's 23.5% annually. So say things don't go this well. Say you get a bad tenant. Say you have more vacancy or more uncollectible rent. It's still pretty darn good. I mean, say the property depreciates in value, the projected cash-on-cash return of this property is 18% annually, Kerry. So if you buy the property for, $69,000 and it goes to zero the next day, as long as you collect that same rent and have that same income to expense ratio, you're going to get an 18% annual cash-on-cash return on your money.
Yeah,
even if it goes down in value.
I see that. You're basically putting down about $14,000, and your positive cash flow is going to come out to about $3,200. Hence, annually. That's where you get the 18%. Not if you're driving right now. I don't want you to crash into the car in front of you, because either you're trying to figure it out or it sounds so big that you lose control of your car and boom. But that's the number. And then modest assumption here for first-year appreciation. I mean, you're figuring a few $1,000s basically, which may or may not come to pass, but it could be higher than that conceivably. Yeah. Because we're seeing, I mean, I know in my area here in Florida, the prices of rentals has gone way, way up from when I rented the home I'm in now. It's up 15-20%. So if the rental price has gone up that much, then the underlying property value had to have gone up somewhat. Not 20%, but 10% is certainly easy to foresee there. In which case, you'd be in really happy territory here.
Here's something else to understand. The overall return on investment we're projecting here on this particular property is 47% annually. And I know people are thinking, this is hokey. This guy is a crook. Look, folks, I've been doing this over 20 years. We've never been sued by an investor. That's never happened. Okay. We have thousands of clients all over the world. Okay. You can listen to my show. You can learn more about it. The overall return on investment, though, is 47% annually. That's the projection. And that includes appreciation. Okay. At below historic numbers, by the way. But let's just strip that out. The cash-on-cash return, which is a very simple metric, is projected at 18% annually. And what I want to bring to people's attention, Kerry, on this little property is that they're buying at only $58 per square foot. That's below the cost of construction. If someone wanted to build that home today, I venture to say it would cost about $85 per square foot. So you've already got locked in something that we don't call appreciation. We call it regression to replacement cost. Okay, so even if that property simply regresses to replacement cost of about $80-$85 per square foot, you've got locked in equity there. Okay, so we are in a time that is pretty special. Rarely do you see a depressed real estate market that is changing pretty quickly, as people know. Prices are rising, no question, in most markets, and these very low interest rates at the same time. That's unusual to see those two things converge. Usually you have a depressed market and you have high interest rates, like in the Jimmy Carter hangover, where you have mortgage rates of 18%, and then the market is depressed. But right now, we've got interest rates, on investment properties of just over 4%. The Housing Affordability Index is at the highest rate ever in history since they've been keeping records. It's never been this good. Interest rates are the lowest they've been ever. I mean, think about the significance there. Think about the opportunity.
Yeah, whatever the reason for it, it's kind of irrelevant. The fact is, you're getting paid by the government on a number of different levels to go in there. But one thing people are worried about that you have to consider in any investment is the concept of risk, that you might lose all or part of your investment. I mean, that's realistic. No matter how unlikely, it's something that you have to think about. How do you analyze risk in your business, Jason?
Yeah, that's a great question. And we may not have time to fully go into it in this show, so maybe on a future episode we can talk about that. But
and people can send you an email to get more info about it. Just give your email address now.
Sure. Well, better to go to the website so we get you in the system properly, and and that's jasonhartman.com, and just click on the contact us form, and you can write long comments there or questions, and people can also call into my show, and we give that number out on my podcast, the Creating Wealth Show, which like yours is free. We've had you on the show, and sure. We want to have you back again to talk about it. But generally speaking, it took me 19 years to discover something that I now call the Hartman Risk Evaluator, and it is a formula, Kerry, to basically reduce dramatically any risk you have when buying a real estate investment. And it includes something I call the LTI ratio. And what that stands for is the land to improvement ratio. And it breaks up the two components of the land value and the improvement value, which is the house or the apartment complex sitting on the land. And, it really takes about 10, 15 minutes to explain it. So probably better on a future episode if you have me back to talk about it. Yeah. But it's a great thing, and we actually have done podcasts on the Creating Wealth Show that explain it in detail, and you can find those on iTunes or at jasonhartman.com. So yeah, it's a great question, and Kerry, it's one of the reasons we avoid high land value markets that are speculative. We are not into gambling. We invest for cash flow. That's why we don't like California or New York or Miami. These very sexy markets are just too speculative. They're too risky. Anywhere where land prices are high, look, you can make money, but gamblers make money too. And I'm just too conservative. I don't gamble. I invest for cash flow. Cash flow is pretty darn reliable. Appreciation, not reliable,
Yeah, well, that's the same thing with stocks too. And, you're looking at dividends versus potential future capital appreciation. And if you don't believe that, look at Apple. Yeah, perfect example.
Yeah, perfect example.
And now all of a sudden they're trying to jack it up by saying, oh, we're going to buy back stock and we're going to jack up the dividend. So now Apple's effectively a different company, and different investors will be attracted to it than before. And Jason, I totally agree with you. I don't believe you should have all your eggs in one basket. I think real estate, with its leverage aspects, with its protection against inflation, protection to some extent against hyperinflation, because if all the mortgages in the world get written off, which I believe is likely at some point in the future, you wind up owning your home free and clear. And while it might be worth a heck of a lot less, your return on investment will go way higher. But we can only speculate on whether the dollar, whether fiat currency, what its future is, where it's going to leave you. It's just something to consider, because your interest payment on the property, and that's another reason, I guess, to like the single family to four family market, is fixed. If you get a fixed mortgage, till the end of that mortgage, you pay that amount, assuming you stay current, and that's a great thing. And then you can look down the road at refinancing if you've had huge appreciation and pull profit out as well, which is something you're not going to talk about here. But that possibility, if the appreciation occurs and there's no tax on that, it's tax-free event, and you get to invest in other properties with the proceeds.
Yeah, think about how income property is the most tax-favored asset in America, and taxes are the single largest expense any of us have. So, you not only get this fantastic tax write-off called depreciation, where the property could triple in value, yet the IRS still views it as though you're losing money. It's a beautiful thing. It's incredible. It's a non-cash or phantom write-off. But when you sell property that has had capital gains, you can exchange it And you can defer the gain forever. You can't do that with stocks. You can't do that with a business. You can't do that with anything else. The government wants you to provide rental housing to people and is willing to give you tremendous incentives to do so. Our whole system, the banking system, the tax code is set up to encourage investing in real estate and take advantage of that. It's a phenomenal opportunity.
Absolutely. So again, your site is jasonhartman.com. I encourage you to go look at it because you can see real life properties, real life scenarios, and then you figure it out. Right now, Jason, I don't think you have like a huge surplus of properties because I look at your site, so many have sold.
In inventory, that's the biggest problem we have in our business right now, Kerry. It's not attracting new customers and new clients. It's attracting more properties because inventory is very, very scarce, and many properties have multiple offers on them. And keep in mind, we do business in many cities in Texas, in Georgia, in Missouri, in Indiana, in Arizona, in many different states. So we're seeing this from a national perspective, and it's the inventory problem it's a significant problem right now. I hope it loosens up because, if we have more inventory, more clients can buy properties and we'll make more money. We're dying for more inventory. It's literally the biggest challenge in our business right now.
Right. And that's happening a lot of places in the country, but we're kind of getting to the peak of the season. After the season's up, probably more inventory will be freed up as well. Jason, again, it's jasonhartman.com. And a loyal, faithful sponsor of the Financial Survival Network. And that's, we only take on sponsors who we believe in what they're doing because, look, I get, Jason, I don't know if I told you, but I get approached by sponsors every single day or multiple times per week. And most of them I just send off. Somebody wanted to advertise GLD. And I said, sorry, I don't believe in it. And therefore I can't take any benefit in selling something that I don't believe in. But real estate, I've made the most money in my life, Jason, other than selling a business in real estate. And in business, I worked in 20-something years. So figuring it out per yearly income on my sale price, the real estate I've done much better on. And unfortunately, I didn't stay in it when I should have because it just is so good for so long.
Yeah. No, that's very true. And most people have the same story, Kerry. Even big entrepreneurs, I remember a friend of mine in a young entrepreneurs organization years ago. I asked him, his dad is very successful. And I said, how did your dad do so well in business? And he said, really the real secret was all of the properties he owned that his business was occupying. That's where the money came from, the real estate. Under all is land. And, real estate, look at the name. The first word is real. There's a reason for that.
Yeah, absolutely. Well, Jason, thanks again for being on the Financial Survival Network. And I'm going to take a closer look. Get some more inventory in there because I'm definitely interested.
We're trying. Hey, thanks for having me, Kerry, and happy investing to everyone.
Thanks. All right, so I keep hearing that many people believe that the best investments are sold by large investment houses. But how many people do you know who got rich in the stock market? I thought so. Jason Hartman has helped thousands of people create real wealth with real estate. He has over 20 years experience, and his company provides the complete solution for real estate investors. Isn't it time you acquired property in diverse, growing markets nationwide for as little as $15,000 down? Don't let inflation destroy the value of your savings, stocks, or bonds. Real estate is the one investment that allows you to profit from inflation. For cash flow and capital appreciation, there's nothing else like it. Make your money work as hard as you do by building an income property empire. Go to www.jasonhartman.com and tell him Kerry sent you.